In this section, we'll focus on tuning customer due diligence to risk. You'll see when simplified checks are acceptable, when enhanced scrutiny is mandatory, and how to justify your choice so controls stay both compliant and operationally efficient. A risk-based approach is about calibration. We don't treat every customer as equally risky, and we don't apply the same level of due diligence to everyone. For demonstrably low-risk situations, simplified due diligence lowers friction while still meeting requirements. Most customers sit in the middle, where standard CDD gives us a solid understanding of who they are and what they do. At the other end are high-risk customers, where enhanced due diligence adds deeper questioning, more documents, and senior approval. The core principle is simple. Controls must match the true assessed ML and TF risk. Simplified due diligence is about doing enough, but not more than necessary, when money laundering or terrorist financing risk is clearly low. Think of it as calibrated efficiency, not cutting corners. We still identify and understand the customer, but with fewer documents or lighter monitoring. It's only allowed where law and policy explicitly permit it, and must never be used when any high-risk indicators are present. Simplified due diligence is never a free pass. It's a tailored response to genuinely low risk. You can usually justify SDD when the customer is highly regulated or very transparent, the product has low limits and simple features, and the business is done in a strong, low-risk jurisdiction, often face-to-face. In return, you can ease the burden. Fewer documents, more time to verify, and lighter monitoring. But that comes with an obligation. Stay alert. If risk indicators change, SDD must be withdrawn and the relationship moved to standard or enhanced due diligence immediately. Enhanced due diligence is what we use when normal checks are not enough. It's still due diligence, but with extra depth, scrutiny, and documentation because the risk is higher. Typical triggers include politically exposed persons, adverse media or sanctions links, complex or opaque ownership structures, cash-intensive or high-risk businesses, crypto activity, exposure to high-risk countries, or unusually large or frequent transactions. When these appear, EDD should switch on. Enhanced due diligence is not just more documents. It's a structured escalation of scrutiny. First, uncover the wealth. Understand how the customer built their overall wealth and verify the specific source of funds behind the transactions you see. Next, trace control. Identify the full beneficial ownership chain until you reach the real people in charge. Then, increase surveillance. Tune monitoring with lower thresholds and more frequent reviews. Finally, require senior management approval to onboard or maintain the relationship, documenting the rationale at each level. Simplified due diligence isn't about being lazy, it's about recognizing genuinely low-risk situations and reallocating effort. In banking, think of domestic salaried employees using basic accounts with tight limits and easy employer verification. In securities, think of large, regulated, publicly listed firms with transparent ownership, doing straightforward investments. In crypto, it's small value, fully KYC'd retail users in low-risk countries using regulated fiat on and off ramps. Across all three, the pattern is the same: verified identity, simple profile, limited exposure, and a documented rationale for low-risk status. Now, let's bring EDD to life with 3 quick scenarios. In private banking, a politically exposed person needs deep source of wealth checks, proof for the initial deposit, and explicit senior management approval. In securities, a complex offshore fund means tracing all beneficial owners, validating fund documents, obtaining independent SOW, and tightening monitoring of subscriptions and redemptions. In crypto, a high-volume OTC trader demands wallet tracing, exchange history, blockchain analytics, and continuously tuned on-chain monitoring. Think of SDD and EDD as 2 different operating modes. With SDD, you've already concluded the customer is genuinely low risk. You verify identity, keep the records, rely on strict product limits instead of deep investigation, and standard monitoring is usually enough. EDD works in the opposite direction. You assume nothing. You dig into ownership, business model, tax, and bank records, and you challenge the plausibility of stated wealth and funds. Controls escalate too: senior management sign-off, tailored monitoring scenarios, and more frequent event-driven reviews. In AML, Your work only really exists if someone else can reconstruct it from the file. Start with a clear rationale. Why this customer is low, medium, or high risk, and which risk factors or model outputs you relied on. Then preserve the evidence: screenshots, documents, decision trees, and external checks. Capture the life cycle: what triggered SDD, CDD, or EDD, and why any de-risking or exit decision was taken. Finally, lock in accountability: who assessed, who approved, when it happened, and any special conditions applied. In real life, the biggest risk with SDD and EDD is drifting into extremes. One extreme is treating SDD as the comfortable default, never revisiting it when new risk signals appear. The other is tick box EDD, where approvals get rubber stamped without real challenge. To counter this, you need tight written criteria, strong QA, and training that makes staff confident to say, "This doesn't feel right." Just as important are simple escalation routes, so borderline cases are discussed, not ignored. Let's close by locking in the essentials. First, always think in terms of proportionality. Your CDD, SDD, or EDD effort should match the level of risk you've identified. Second, SDD still needs clear justification. It's lighter, not absent. Third, EDD means going deeper and higher with more information and senior approvals. Finally, document everything so your decisions remain transparent and defensible.